I learned the I learned the real estate cycle there. I came into the bank in 1986, which was really a peak of the market, and the team that I was working on was focused on the high net worth real estate developers. And more than one transaction, we were doing loans that were over 100% of cost. So if it cost you $100 million to develop an office building, and you had an appraisal that when it's leased up, it'd be worth 150 million, we would loan 120 million on it. And more than one transaction was that way. And so it was quite an education, because my job was to come up with the analysis on how it was going to get repaid, and it seemed to be very dependent upon some vision in the future, and not on cash flow today. And so when I came out to business school, I had aspirations. Well, I can do that too. And by the time I was in business school and launching my real estate career, the S&L crisis had completely pulled the plug on the abundant availability of debt capital. But it was really helpful to get an education on just how capital flows, whether it's equity driven or debt driven, affect the fundamentals of real estate. And that was a lesson that Jim Worms had brought from leading the investment banking group at Solomon Brothers, and also at Eastdil. And so as we were growing Paladin together over the last 30 years, we really tried to focus on sectors that weren't as vulnerable to capital flows, in fact, which had barriers to entry for one reason or another for institutional capital. We don't like competition. And that's why we've ended up focusing in the sectors in Latin America and also here in the United States that are less competitive from an institutional capital perspective.